Please give us your definition of a hedge fund.
Okay. Andrew, there are quite a lot of definitions out there of hedge funds, globally and then locally. FSB has a definition. But broadly speaking, it means you have the ability to sell shares, to sell short. And I'll get into that a little bit later. So that's the one big thing. And the second one is you're able to lever your positions, use gearing to gear up your returns. But on the risk side, I guess if you're managing risk, it could mean you could lose more money as well if you use gearing. But simply put, I mean, if you look on the shorting side, let's assume you were looking at the share Woolworths, which a year and a half ago was trading at around 90 Rand. You didn't like it. They've done a deal in Australia, David Jones, not great deal. And you thought the share was going to go backwards or to fall. What we would do is then go and borrow the shares, so we didn't own them, and we would sell the stock short at 90 Rand and hope to buy it back at a lower price. If today you went out right now and bought Woolies, if we'd kept that position on, we went to buy it back today, the share's trading at 55 Rand, we would have made the profit from the move from 90 down to 55, which is somewhere around 80% or so return. So that would be the ability to go out and short. So like a long-only player, we go out there and we buy shares we like. Shares that we don't like, we go and sell them short and hope to buy them back at a cheaper price. Okay, one of the other things I should also mention, hedge funds should be seen as complementary to other products out there. There's a lot of noise around passive these days, and I think in big developed markets like the US is very much so, passive is extremely good because it's very difficult to beat the S&P over time. When you get to smaller markets, then there's a lot more reason to have some active managers. You go into Africa particularly so, because not very well covered and a lot of opportunities there. But so passive is a place for passive in some of the very big markets in my view. Active also as well, big long only active managers. There's some very good guys out there. And then the hedge fund does something slightly different. So I think the three different strategies out there one should see as complementary. And one of the things is, if you look at Reg 28, even the pension funds, they say up to 10% can be put into hedge funds. So it's a small portion. We find that when you go into the when you go into the individual space, high net worth people, probably that percentage could be up to around the 20% of the overall assets sort of makes sense.